Hey everyone, and welcome to This Explainer. If you're anything like us and you absolutely love dissecting market mechanics, figuring out exactly why the financial world moves the way it does, well, you are definitely in the right place. Today, we're unpacking the totally wild events of the trading week that ended on July 3rd, 2026. Now, it was a shortened holiday week, but man, it packed an absolute wallop of a surprise that sent shockwaves and some pretty massive capital rotations rippling through global markets. We're going to break down exactly how to interpret that week 57K jobs report, what actually happened, and most importantly, why it matters so much for the economic road ahead. Okay, let's just dive right into it. The entire story of this week literally hinges on one single glaring number: 57,000. That is the exact number of payrolls added to the U.S. economy in the June jobs report. Now, in the high-stakes world of macroeconomic data, a number like this, it acts like a sudden massive bucket of coolant poured right onto a roaring economic engine, and it's safe to say it caught almost everyone completely off guard. To really wrap our heads around just how shocking this was to institutional investors, we have to look at the consensus expectation. Going into the report, the economy was projected to add around 115,000 jobs, but the actual print, well, it came in at exactly half that, plus 57K. I mean, that is a massive, massive miss in expectations. Usually when economic data just falls off a cliff like this, you'd expect outright panic on Wall Street. Which brings us to the core paradox of this entire explainer. You really got to ask yourself, why on earth did terribly weak jobs data trigger a record-breaking stock rally? Because, crazy enough, that is exactly what happened. The Dow Jones Industrial Average didn't crash on this news, it actually hit multiple fresh record closes. To understand this totally counterintuitive reaction, we need to look under the hood.
And that brings us to Section 1, the market's surprising reaction. Basically, a tale of two markets.
You see, the stock market is never just one single entity moving in perfect unison. The divergence across the different indexes here tells a story of a deeply divided market. While the S&P 500 hung out near its highs, closing the week up around 1.8% at roughly 7,483, we saw a huge split below the surface. The tech-heavy Nasdaq, which closed around 25,833, actually faced some real selling pressure, specifically from weakness in semiconductors. Yet, at the exact same time, the traditional Dow Jones soared to record closes around 52,900, and the small-cap Russell 2000 posted really solid gains approaching 3,000. So, tech cooled off, while traditional and small-cap stocks caught fire. Moving right along to Section 2, the interest rate connection and the Fed's next move. To understand why investors suddenly favored traditional businesses over high-flying tech, we've got to connect the dots between that weak jobs data and the Federal Reserve. The mechanics here triggered a really rapid chain reaction. Step 1. The weak 57K jobs data hits the wire. Step 2. The market immediately calculates, hey, a slowing labor market means Federal Reserve Chairman Warsh, who we know is highly data-dependent, is way less likely to hike interest rates in the near term. Step 3. Because those rate hike odds drop, bond yields and the US dollar fall. And finally, Step 4, those lower borrowing costs act as a massive relief valve for smaller companies and traditional sectors, causing value stocks to absolutely surge. So in a weird way, the bad economic news was actually perceived as great news for interest rates. Now, here's where it gets super interesting. This reaction birthed the dominant market narrative for the week, a concept known as Goldilocks with cooling. Think of the economy as an overheating engine. This weak jobs report was just the perfect splash of coolant. Economic growth is slowing down just enough to get the Fed off the market's back, right? But, and this is key, it's not slowing down so aggressively that it signals a catastrophic full-blown recession. It was perceived as the absolute perfect sweet spot. But wait, why was the market so incredibly confident this wasn't the start of a recession? Well, it all comes down to one absolutely crucial detail. The unemployment rate held steady at a very manageable 4.2%. The labor market is cooling, for sure, but it is not collapsing. That 4.2% figure is literally the glue holding this entire bullish narrative together. Believe me, if that number had spiked instead, we would be having a very, very different conversation about market panic right now. Which sparks Section 3, the great value rotation, moving beyond AI. Because panic didn't set in, institutional investors decided it was time to move their money around. Let's look at exactly what the smart money did during this shortened week. We saw massive, sweeping moves across interconnected asset classes. Gold
It surged above $4,100 an ounce, driven by a sudden spike in safe haven demand and central bank buying. The 10-year Treasury yield fell to 4.49%, signaling lower growth and inflation expectations. The US dollar index softened to around 101, which, by the way, is great for exports, but definitely pressures multinational earnings. And Brent crude dropped to roughly $72 a barrel. Now, lower oil helps ease inflation, but it also signals that global demand might be softening up a bit.
And this perfectly illustrates the defining theme of the week. Investors basically looked at the slowing economy, locked in their massive profits in high valuation tech and AI names, think companies like AMD and Micron, and aggressively reallocated. They took all that cash and rotated it straight into value stocks and small caps, hunting for broader resilience and diversification. It was a breathtakingly fast shift away from the big tech darlings and right back into the traditional economy. So where do we go from here? That brings us to Section 4, Navigating the Economic Outlook, looking at risks and resilience. We have to balance the incredible momentum of this market rotation against some very real flashing risks. Flashing caution light number 1. The Buffett indicator is sitting up at 230 to 236%. That is pushing historical highs, folks. It's screaming that equities are significantly overvalued relative to actual underlying GDP. Now, yes, earnings growth and AI productivity are helping to justify some of this, but valuations this high, they leave the market incredibly vulnerable to any negative surprises.
And this creates a really fascinating psychological contrast. On one hand, the VIX is sitting super low at 16 to 17. That points to deep complacency. Investors just aren't currently paying up to protect against a crash. But simultaneously, the CNN Fear and Greed Index is sitting between 30 and 32, squarely in fear territory. So the data tells us volatility is low, but the underlying psychology of the investor is actually highly cautious and fearful. It's a very fragile state of mind.
When we roll all this data up for the next 12 months, we're basically looking at 3 clear scenarios. The base case is the soft landing, continued capital rotation, with the Fed stepping in to ease policy if needed. The bullish scenario, well, that requires the AI productivity boom to genuinely materialize, paired with fiscal tailwinds pushing the market even higher. But the bearish risk is very, very real. If inflation proves sticky, forcing the Fed to reignite rate hikes, or if that 4.2% unemployment rate sharply worsens, this heavily valued market could face a severe, severe reset. So we want to leave you with this question to chew on for your own strategy. Is this beautifully timed rotation the ultimate proof of a successful soft landing? Or, considering these sky-high valuations and that vulnerable psychology we talked about, is this merely the calm before a really painful, higher-for-longer interest rate reversal? The data-dependent weeks ahead are going to hold the answer. Thank you so much for joining us for this explainer. Keep your eyes closely on the data, and we will catch you next time.